Welcome back to The Deep Dive, your shortcut to being well-informed. Today, we're plunging into the latest earnings call for Loma Negra.
Argentina's big cement and construction player.
Exactly. We're looking at their second quarter 2025 results. And on the surface, the numbers look, well, pretty dire. A huge drop in profitability. But as we start to peel back the layers, you'll find this really fascinating paradox. You've got soaring sales volumes.
Which sounds great.
Right. But they're clashing head-on with crumbling margins. It's this classic battle, growth versus profitability.
And we're here to unpack what this, crucial disconnect means for investors, for the company, and maybe for the wider Argentine recovery picture too.
Yeah, it's a really interesting case study.
It is. We'll be focusing on how management sort of framed their performance and their outlook, and maybe more importantly, how the market reacted, because the reaction tells its own story.
Definitely. It's a prime example of needing to figure out what's really going on beneath the surface, especially in, an economic landscape like Argentina's, which can be, let's say, unpredictable.
Right. So where do we start? The headline numbers.
Yeah, let's get straight to the headlines because they were certainly eye-catching. So Loma Negra's second quarter, it saw a really significant year-over-year decline in profitability.
Huge decline.
GAAP EPS, that's generally accepted accounting principles, earnings per share, it came in at ARS 0.6809. That's a staggering 99% drop from the year before.
99%? Wow.
Yeah. And revenue also decreased 8% year over year in real terms. It landed at ARS 174.5 billion, which is about US $149 million. And that actually missed the consensus estimates.
It's estimates too.
And adjusted EBITDA saw a 30.6% year over year decline. The EBITDA margin contracted pretty notably by 691 basis points, so that's save 0.91 percentage points down to 21.2%.
Oof. Okay, so those are the rough numbers. Now, how did the market take this? Because sometimes the market sees through things or reacts differently.
Well, the immediate reaction was quite sharp.
Yeah, as you might expect with those figures.
Right. Following the earnings release, the company's stock, it experienced a significant drop, fell nearly 8% by the close of the next trading day.
Okay.
And that was accompanied by a pretty considerable spike in trading volume, too.
So people were definitely reacting, selling off.
Yeah. This reaction really underscores, I think, investor concern over that margin pressure, despite, some underlying positives that management did try to highlight.
The market clearly weighed those negatives, the margin compression specifically, more heavily, at least initially.
Okay, so let's unpack this apparent contradiction then. Because despite those headline financial misses, there was a clear bright spot.
The volume side.
Exactly, the volume front. Loma Negra reported an impressive 11% year-over-year increase in cement volumes.
That's pretty solid growth.
It is. And if you look broader, overall cement dispatches across the whole industry grew even more by 14% year over year.
Okay, so demand is definitely there.
It seems so. This was driven by a healthy mix, industrial, commercial, larger housing developments, plus a moderate uptick in provincial public works. So the demand signal, it appears to be significantly improving. That's a powerful positive, right?
Absolutely. I mean, selling more stuff is usually good news.
Yeah.
But what's fascinating here, like you said, is while the volumes are growing,
the margins aren't falling.
Exactly. They're telling a very different and much tougher story. Management was actually quite candid about it. They attributed this margin contraction to an intensely challenging competitive environment.
Okay.
Which, is often typical of an early stage economic recovery that isn't quite solid yet. Everyone's fighting for a piece of that returning pie.
Scraping for market share.
Right. And on top of that, the transition to this new low inflation scenario in Argentina meant price adjustments were more spaced out, more limited. It made it incredibly difficult to fully pass on any rising costs.
That's a tough pill to swallow. So if demand is clearly there, what's stopping them from just pushing through price increases to cover costs, improve those margins? Is it purely the competition or is there something else maybe?
Well, I think you've hit on the key point. It's not just that there's competition, but the nature of it in this specific recovery phase.
Okay.
With inflation cooling down, companies can't just rely on those sort of automatic inflation-linked price hikes anymore.
Right.
Instead, they're forced to compete more aggressively on price to capture market share in what's still, a somewhat fragile environment.
So even though Loma Negra highlighted effective cost management, they mentioned things like lower depreciation, reduced maintenance, better energy input prices.
Right. They did point to those efficiencies.
But those savings, they just weren't enough.
Just simply not enough. Not enough to fully offset the top-line revenue decline, which remember was down 8% in real terms, and those aggressive pricing dynamics.
Oh.
And this hit most segments. Like, look at cement. Revenue declined 9.9% despite that 11% volume increase.
Selling more, making less revenue.
Precisely. And concrete revenues were down 1.1%, even with a huge 44% volume surge. It really shows you how intense that pricing pressure must be.
Okay, let's shift gears a bit. What about the balance sheet? How's that looking amidst all this?
Well, net debt did increase sequentially, up to US $215 million. And the net debt to LTM adjusted EBITDA ratio is now 1.34 times.
LTM, right? Last 12 months. So 1.34 times. Is that worrying?
It's not alarmingly high, but it's creeping up. Something to watch. But they also made some strategic moves in July. They issued a new corporate bond.
Ah, yes, the bond. That was what, US $112.9 million?
That's right, 8% interest rate over 2 years. And the main reason they said was to address upcoming debt maturities and extend their overall debt duration.
Which seems like a sensible move, right? Gives them more breathing room.
Exactly. It shows a clear focus on funding resilience, which is smart in this environment. And, with 71% of their debt being USD denominated.
Right, mostly dollars.
It does balance the foreign exchange risk somewhat, but it also means those dollar interest payments are a meaningful factor. Investors need to watch those yields.
Makes sense. And what about that other initiative they mentioned, the 25-kilo bags?
Oh, yeah, the cement bags. That was quite interesting. A significant innovation, they called it.
Required a fair bit of investment, too, didn't it? Something like US $70 million in capex for the upgrades.
It did. And you can imagine construction workers are probably quite happy about lighter bags.
Probably. But beyond, the ergonomics and safety, how significant is this strategically for market position, efficiency?
Well, that's the idea. It's not just about happier workers. Management positioned it as being geared towards defending market share.
Okay.
And enhancing handling efficiency at job sites. So it could offer a real competitive edge if it's adopted well and actually improves logistics.
Interesting. Okay, let's zoom out then to the broader economic picture in Argentina. What's the backdrop here?
Well, the macro picture actually looks somewhat encouraging, on the surface at least. Argentina's GDP grew by a pretty robust 5.8% year over year in Q1.
5.8%, that's quite strong.
Yeah. Signaling an economic recovery is underway. Full-year forecasts are hovering around 5% growth. Management definitely views this as a very positive signal.
Right.
And they expect the Construction Activity Index, the IC, to keep signaling a positive rebound for the sector.
So this raises that key question again for you, the listener. If the macro environment is improving, why are we seeing such intense margin pressure at Loma Negra?
Exactly. Management's explanation was that while the recovery is underway, it's still, in their words, incipient and not uniform across all sectors.
Okay, incipient. So early days, patchy.
Right. They pointed back to those competitive dynamics being particularly challenging in this early stage, like we discussed. Plus, the upcoming midterm election always introduces potential political volatility. Businesses get a bit cautious.
That makes sense. Always a factor.
But they did remain optimistic. They believe the consolidation of the current economic model will eventually lead to a more stable environment, which should enable more sustained growth and, crucially, allow for better pricing discipline down the line.
So they're banking on things firming up. But the market's reaction, dropping the stock 8%, suggests maybe some skepticism about how quickly that firming up will happen or if it will happen smoothly. What are the biggest risks that could derail that optimistic outlook?
That's a critical point. I mean, the biggest risks are undoubtedly potential bumps in the road for Argentina's broader economic stabilization.
Like what specifically?
Well, if inflation proves harder to tame than hoped, for instance, or if political decisions around those midterm elections introduce new uncertainties or policy shifts, that could definitely prolong this incipient phase.
Keep the pressure on.
Keep the pressure on, exactly, and delay that margin normalization they're hoping for. Also, while management expects the competitive landscape to stay stable, you can never rule out aggressive moves by competitors that could undermine their pricing power even further.
So it really is a bit of a tightrope walk. National economy, politics, market competition, all feeding into it.
Definitely. It's complex.
So with all that context, what is the official outlook from the company? What are they telling investors to expect?
Well, they reaffirmed their expectation of achieving double-digit volume growth for the full year 2025. So they're still confident on the demand side.
Okay, holding firm on volume growth.
Yes. And they anticipate margins will normalize as this recovery consolidates. They foresee a recovery in pricing, maybe even starting in the coming months, potentially getting above inflation by the end of the year.
Now, that's a crucial forecast. If they can pull that off, it changes the profitability picture significantly.
Absolutely. That's what the market will be watching like a hawk. They also noted the competitive environment should remain stable. No major shifts expected there soon.
Any other drivers? Public works.
Yeah, they mentioned public works activity in key provinces like Santa Fe and Buenos Aires is projected to have a positive dynamic in the coming months. So that should help underpin demand.
Good sign.
However, that big privatization program for roads the president announced, they expect minimal impact from that in the second half of this year.
Okay, so not a near-term boost.
Not near term, but they did suggest it could become a significant driver for 2026 and beyond. So maybe a longer-term positive for infrastructure development that isn't really baked into the immediate outlook yet.
Right. So for investors listening, what are the key things to watch? What's the next catalyst?
The next big data point will be the third quarter 2025 earnings print and their updated guidance, which should come in early November.
Okay, Q3 results. What are we looking for there specifically?
Evidence of that price and mix normalization in the cement segment. That will be absolutely crucial for seeing a profitability recovery take hold.
Price increases sticking, basically.
Essentially, yes. And alongside that, you need to watch the broader Argentine macro developments, sustained public works activity, further positive GDP prints, maybe some favorable foreign exchange dynamics. Those all play a role.
And maybe even how that 25-kilo bag initiative is going. Is it being adopted? Is it helping?
Could be a factor in sentiment, yeah.
Yeah.
Ultimately, the company needs to show both things: sustained volume growth and margin stabilization. They need to transition from this phase of, share defense and recovery.
Just holding on to what they have.
Right, into a phase of real operating leverage, where those increased sales actually flow efficiently down to the bottom line, boosting profits. That's the turning point everyone's waiting for.
Okay, so we've laid out the conflicting signals, the market reaction, management's optimism, the risks. Now let's get to the fun part.
The what if.
Exactly. Translating this into a provocative idea, let's get into our This Is Not Financial Advice segment, where we pitch an outrageous but plausible trade idea based on today's deep dive.
All right. So considering Loma Negra's Q2, you've got that strong volume growth signaling underlying demand is there.
Yeah.
But you also have that significant margin compression because of the early stage competitive recovery and the new low inflation environment.
And the market reacted sharply negative to that margin story.
Right. So there's this disconnect. Management sounds pretty optimistic about margin normalization and pricing recovery by year end, but the market clearly hasn't fully bought into that yet, especially given how the stock dropped.
Okay, so where's the outrageous but plausible trade in all this?
Here's where it gets, as you say, really interesting. Our trade idea for a, let's say, bold investor is a highly targeted strategy we're calling the Argentina recovery overlap.
Okay, Argentina recovery overlap. Intriguing. What is it?
Step 1, go long Loma Negra stock. Loma.
Betting on management's thesis playing out.
Exactly. Betting that margin expansion and pricing recovery do materialize in Q3 and Q4, driven by that consolidating economic recovery and the provincial public works picking up. The stock took a hit short term, but remember, it's still up over the last year, suggesting there might be long-term potential if they're right.
Okay, so long Loma, that's the core bet on the company itself. What makes it outrageous but plausible? Where's the overlap or hedge?
Right, here's the twist. To hedge against the risk that the broader Argentine recovery is maybe slower or bumpier than Loma Negra needs.
Hedging the macro risks.
Precisely. Simultaneously, you take a short position on a basket of Argentine local currency, short to medium-term government bonds.
Whoa, okay. Shorting Argentine government bonds. Explain the thinking there.
This is basically a bet that if the broader macroeconomic and political environment stays volatile, or if inflation proves harder to tame.
Which are real risks we discussed.
Exactly. Then local bond yields could rise, meaning prices fall good for a short position, credit spreads could widen, the peso could weaken. These things could negatively impact other parts of the Argentine market.
While Loma Negra potentially could still benefit from its own specific construction rebound.
That's the idea. You're betting on Loma Negra's operational strength and its essential product within a still fragile macro environment. You use the bond market short to express skepticism or hedge against that broader macro fragility.
So you're effectively betting on Loma Negra specifically, but against, or at least hedging against, a smooth ride for the Argentine economy as a whole.
You got it. It's a nuanced play on a complex dynamic situation, betting on micro strength amidst macro uncertainty.
Definitely outrageous, but plausible. A very interesting construction.
We aim to intrigue.
So there you have it, Loma Negra's Q2 2025 earnings. It really is a story of promising volume growth, battling some intense margin pressure.
All set against that backdrop of Argentina's unfolding and still somewhat uneven economic recovery.
Yeah, the divergence between management's optimism for a turnaround and the market's immediate, more cautious reaction that presents a really compelling narrative to keep watching.
Absolutely. The path back to sustained profitability is really going to hinge on that pricing discipline coming through, the competitive landscape stabilizing, and getting some help from the broader macro picture.
So what stands out to you from this deep dive? We've covered a lot here, from that frankly perplexing 99% drop in EPS to the strategic move with the 25-kilo bags and a pretty provocative trade idea.
A lot to chew on.
Definitely. And remember, everyone, that trade idea we discussed is purely for informational and entertainment purposes. It was absolutely not financial advice. Always, always do your own research and due diligence.
Couldn't agree more. Thank you for joining us on the deep dive. We really appreciate you trusting us to distill these often complex earnings calls into hopefully some actionable insights.
We'll be back soon with another deep dive. Until then, stay informed.